More people will pay tax on their Social Security benefits this year than at any other point in history, and the problem is only getting worse. So in today's video, I'm going to explain the formula for how your Social Security benefits are taxed, why more and more of that benefit is being taxed, and finally, how you might be able to avoid paying tax on your Social Security completely. But first, my name is Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. Nearly 50 years of the Social Security Administration, there was no tax on your Social Security benefits. And then in 1984, we had the first tax on Social Security benefits implemented. Now, over the past 40 years, both Social Security payments and federal income tax brackets have continued to shift upward to compensate for rising inflation. But the income thresholds that result in Social Security benefits being taxed have not been adjusted, in 40 years. So when the original tax took place in 1984 during the Reagan administration, it was estimated that about 10% of Social Security recipients would have to pay tax. By 2022, 48% of recipients were paying tax on some of their Social Security benefits, and they had paid nearly $50 billion. That number is going to cross 50% this year. Now, avoiding tax on your benefits is possible, but it becomes harder and harder once you turn 73 and you're required to start taking your required minimum distributions from your 401ks and your IRAs and other qualified tax-deferred accounts. Now, one small benefit or one small consolation prize is that most states do not tax Social Security benefits. In fact, 37 states do not tax Social Security benefits, but there are a few that do. But if you're able to work around the federal tax on your Social Security benefits, that should take care of your state tax as well. So let's first explore how your Social Security benefits are taxed. There's a formula called provisional income or combined income that determines whether your benefits will be taxed. It works like this. You take your taxable income. This is your W-2 income, investment income, dividend income, rental income, pension income, etc. And then you add in tax-exempt interest. So for most people, it's going to be interest from municipal bonds, which is popular with higher income retirees. And then it's also going to include excluded foreign income. So sometimes if you have income that you earned in a foreign country, you might be able to exclude that from your taxes. That's going to get added in for this provisional income formula. Then they're going to take 50% of your Social Security benefit. So if it's a $20,000 benefit, you're going to add $10,000 of that to this formula. This is all added together, and this becomes your provisional or your combined income. So now that you have that number, next there are a number of thresholds that determine what percent of your income is subject to Social Security tax. Now, this isn't the amount of the tax on your Social Security, but it's just what percentage of the income is subject to tax. So here's how it breaks down. Single filers who earn less than $25,000 in provisional income, no benefits are taxed. If you earn between $25,000 and $34,000 or up to $34,000, 50% of your benefit is subject to tax. If you earn greater than $34,000, 85% of your benefit is subject to tax. If you're married filing jointly and you make less than $32,000, $0 of your benefit is subject to tax. If you earn between $32,000 and $44,000, 50% of your benefit is subject to tax. And if you earn over $44,000, again, in provisional income, 85% of your benefit is subject to tax. So let's look at a real-life example, and we'll continue with Phil and Claire Dunphy, although the numbers will be a bit different. If you haven't picked up by now, I'm a big fan of Modern Family. So let's say that Phil and Claire have $60,000 in Social Security benefits between the two of them, but no other income. So when they're trying to calculate their provisional income, since they have no other income coming in, they're going to take 50% of $60,000, and so their provisional income is $30,000. Therefore, their tax bill will be zero. Pretty simple. But now let's say Phil and Claire have to take $30,000 of required minimum distribution. So now their ordinary income will be $30,000. But instead of simply paying tax on that $30,000, now they'll owe tax on $50,000 because nearly $20,000 of their Social Security income is now subject to tax. So let me show you here on this calculator, and I will put a link in the show notes so you can play around with this as well. But let me show you here on the calculator what this would look like. Okay, so here we have a calculator. I have a link on the website if you want to play around with this yourself. But here they're going to be married filing jointly. Remember, they have $60,000 in Social Security benefits. So let's say they got nothing else. So as you see, $60,000 in Social Security benefits between Phil and Claire, and then $0. But now they have other incomes. They have RMDs that are coming in. So they have $30,000 of RMDs. Now $20,000 nearly of their Social Security benefit is going to be taxed. But let's look at this another way. Let's say you have a couple that has $30,000 in Social Security benefits. So let's say you have $30,000 in Social Security benefits, and then you have $30,000 in other income coming in. So the same amount, if Phil and Claire had $60,000 in Social Security benefits coming in, zero tax. But if you have $30,000 maybe from pensions or RMDs and $30,000 in taxable income, you're going to have almost $7,000 of your Social Security benefit is going to be subject to tax. So even though you have the same amount of income, a higher proportion of your Social Security benefits are going to be taxed because of what I believe is an archaic formula, but it is what it is. So you can play with this calculator. I'll put a link, as I said, in the show notes. You can play around with the calculator and get a sense of how your benefits might be taxed and how different changes might impact the taxation of your Social Security benefits. Does that make sense? So how do you avoid paying tax on your Social Security benefit? The answer is with very careful planning. Now, if you're younger and watching this, the easiest way to plan for this is by really prioritizing your Roth IRA and your Roth 401ks. The rules on Roth 401ks continue to improve in favor of taxpayers. But if you're like most people watching this video, you already have a large sum of money in tax-deferred accounts like a 401k or a traditional IRA, and you're going to have to take distributions out of those accounts either to live or because of RMDs. And when you do, you're going to have more ordinary income, which could cause more of your Social Security benefit to be taxed. So here are a few tips to reduce tax on your Social Security benefit and to reduce your taxable income. So the first thing you can do to reduce tax on your Social Security is simply to delay the benefits. The longer you delay, the more time you have to begin drawing down your taxable and your tax-deferred accounts before your Social Security benefits kicked in. So for many people, it makes sense if you're working on that calculation, do I take my benefits at age 62, or do I take them at full retirement age at age 67, or do I delay until age 70? For many people, it makes sense to delay to age 70, even if they're going to retire at age 62, to give them 8 full years to begin drawing down those other accounts. The second thing you can do, and it's related to the first, but you can draw down your traditional IRA or your traditional 401k early. You could maybe even put some of that money, if you don't need to live on it and you're not going to do a Roth conversion, you could put some of that money in just a taxable account and let it continue to grow in there. And often, and this seems a bit counterintuitive, but often a taxable account can be more tax advantageous than, say, a traditional IRA or a traditional 401k. The next thing you can do, and this is in your taxable account, but you can reduce your dividend and your interest payments. Retirees often have a large amount of money in bonds and dividend-paying stocks, but those produce income. But often in that taxable account, you're better off with capital appreciating assets with lower dividends and payouts. Therefore, it keeps your taxable income lower. The other thing you can do in your taxable account is overweight your international holdings. So typically in a diversified portfolio, you'll have 20 to 30% of your portfolio in international stocks, normally through either an ETF or a mutual fund. One thing that a lot of people don't know is there's often a tax rebate that you receive on the international funds because those companies paid tax in their country of origin, and so it doesn't make sense to pay tax there and to pay tax at home. And so you'll get a rebate on the tax that was paid that, if it's in a taxable account, will come through as a tax deduction. If that is in your qualified account, there's no benefit. So what some people do is they'll overweight their holdings of international stock in their taxable account, and they'll underweight it in their qualified accounts where those deductions have no benefit. The next thing you can do, and this again is in a taxable account, but you can do tax loss harvesting. So you can sell your losses to offset gains. Now there are a bunch of rules around tax loss harvesting. It really will take another whole video, which I'll do at some point. Just a quick example. If you have a capital loss, it can only offset ordinary income up to $3,000. If you have no capital gains for it to offset, so let's say you have a $30,000 capital loss, it can offset $3,000 of ordinary income. So that might actually help bring your income down for purposes of your Social Security benefit, but you still have $27,000 in losses that you weren't able to take. And those just roll forward to next year. If you don't have any capital gains that next year, you take $3,000 off your ordinary income and roll the next $24,000 to the next year, and so on and so forth. But tax loss harvesting can be a great way to reduce the income in your portfolio. The next thing that you can do, and this is related to tax loss harvesting, we're starting to see this more and more, and we're starting to do it for some of our clients. It typically is in larger portfolios or larger taxable portfolios. There's a threshold for it to make sense. But what you can do is you can do direct indexing. Most people now know the benefits of a passive portfolio with index funds. But what you can do now is you can have a direct index. So you're still tracking the index, so S&P 500 or whatever the index might be, but you own micro slices of all the different companies in that index. So let's take the S&P 500 as an example. You would own most of the stocks in the S&P 500. So instead of just owning one S&P index fund, you would own 400 or 500 different stocks. And the chances are that in any given year, even in an up year, some of the companies in that index are going to be down. If you own just an index and that index is up, the S&P 500 is up for the year, there's no tax loss harvesting. But if you have a direct index, so you basically recreated the index or your custodian has recreated the index, this would be way too complicated to do on your own. But now you have these 400 to 500 companies in your portfolio and you can sell just the ones that are down to offset the gains in your portfolio. So you can take a loss even in years when the market is up. And then you can use those losses to offset some of your ordinary income or some of your other capital gains in the same way you can do with tax loss harvesting. The next way you can avoid tax on your Social Security, and I'm just going to kind of glaze over this because I have an entire video on this, but at the end I'll link to my playlist where I walk through a number of strategies around RMDs and Roth conversions. But the next thing you can do is do a Roth conversion before your Social Security payments kick in. This is one of the reasons I'm a fan of delaying Social Security as long as possible, is it gives you more time in years with lower income to start converting that money. Now you can do it after your Social Security payments kick in, and for some people that might make sense, but whenever you do a Roth conversion, it's going to come out as ordinary income, which there's a high likelihood that could cause more of your Social Security benefit to be taxed when you do that conversion. Now, the final way you might be able to reduce your taxable income, particularly in the early years, is with real estate rentals. With the right strategy, particularly in those early years, real estate can create more paper losses than income coming in, and that can help reduce your income. So for example, if you rented an Airbnb in your house or a back house, you might be able to offset most of the income that's coming in. So you're getting income that's flowing in to help you support your retirement, but you're able to offset most of that through depreciation. So it's not pushing you up into the next tax threshold. So that's why a number of my clients will have rental income, because it provides some cash flow to help pay the bills, but it doesn't raise your taxable income. Okay, that's it for today. In the show notes, you can find a link to a calculator to help you play around to see how much of your Social Security benefit would be subject to tax and how much additional income will impact that. So I'll put a link to that calculator so you can play with that on your own. And also I put together a whole playlist of taxes and retirement that I encourage you to watch. I talk about RMDs, Roth conversions, and the best way to withdraw money in retirement. Thanks for watching.